Welcome to Financial Focus, brought to you by Gulf Coast Financial Services founder and CEO, John Kuykendall. John and his team of financial, legal, and tax professionals have provided North Florida savers and investors sound, comprehensive financial guidance for over 25 years, helping you to achieve important life and planning goals. Be sure to like, subscribe, share, and tune in for more Financial Focus by visiting gulfcoastfinancial.net.
And welcome into the program. This is Financial Focus, brought to you by the team at Gulf Coast Financial Services, North Central Florida savers and investors, your resource. They've been named Best of the Best in Financial Services, 6 years running by the Lake City Reporter. Definitely a feather in the cap. John Kuykendall, CEO, founder, and his team there do a great job in helping you map out your goals and then structuring a plan to help you achieve them. If you would like assistance, they always make their time available. No cost, no obligation. If you're serious about your planning and your financial future, give them a call. 386-755-9018, 386-755-9018. And John, I love the topic of the show today, really bringing this back to basics, because we are going to have a much better chance of achieving our financial goals if we understand the investment options that we have available to us.
Yeah, Peter, I'm really excited today to talk about a few of my banking things from my banking days. But, you know, Peter, we've been doing this now we're going on 29 years. So in the 29 years that Gulf Coast has been in existence, we have certainly seen a lot of things, learned a lot of things, and we are really excited about the year coming up. But just throw that in, you know, we're getting a little age on us.
Yeah, well, hey, experience. There are some benefits there that you've learned from the good, the bad, the ugly. Times certainly have changed, but some of the planning strategies have changed and evolved with them. Some have remained pretty constant. And so we're going to be talking about those today. And kind of first things first, John, you mentioned it there, the banks. This is probably the most common, the most utilized. People know the banks, but there's a time and a place where banks and bank products are appropriate. And then there's probably a time and place where they're not. Maybe that's true for each one of these options, but let's dive into banks in particular first, if you would.
Yeah, Peter, you know, back 20 years ago, 25 years ago, banking wasn't a bad place to put some of your money because the rates were higher, of course. But with the lower interest rates we got now, and with what checking accounts and savings accounts are paying, I don't see having any more money in my checking account than I need for liquidity. So if I needed, you know, if I've got pay my bills each month, keep that money in my checking account, but don't keep any more than that, because what you're doing is you're really losing the lost opportunity cost having that money invested in something else. And as you know, with inflation, 1.5%, 2%, banks aren't paying anywhere close to that on my savings account, my CD or my checking account. And you know from history that a lot of people keep a lot of money in their checking accounts because it makes them feel good.
Yeah.
In my savings account, which pays a little higher interest rate, then, you know, I can put a little bit more of my reserve money there. You know, I always say that we need 6 months in reserve, and certainly putting some more of my money in that and then having it transferred to my checking account if I need it is certainly an option to go. It doesn't pay much more than a checking account, but it does pay a little bit more. But mainly the checking and savings is for your short-term money that you're going to need to pay bills, liquidity, things like that.
All about being able to get your hands on it when you need it. It's not
write a check.
Really for any other purpose other than accessibility and safety, not providing a whole lot of growth there, obviously, John. But I heard the definition of an emergency account. Its purpose is to prevent emergencies. If you've got the emergency account, you don't have emergencies, you have inconveniences, so long as you can stroke that check and take care of a problem. It's not an emergency. But if you got to go into debt or you can't handle an inconvenience, then that becomes an emergency. That's the purpose of the bank. Over and above that much money, we really are, you mentioned it, losing money safely, and we've got to start looking at other options.
All right. Of course, money market accounts, as you know, are a thing that came out in the 80s, but we're limited to the number of checks we can write. Doesn't pay much more interest than savings accounts, but it is another source of liquidity. And if your bank's paying more, then that's certainly something you should use it for. But remember that you're limited by the number of checks that you can write. As CDs, which the banks also offer, pay a little bit more money, but they're for a set term. Once I put my money in there, I have to leave my money there, or I'm going to lose my interest if I take it out early.
So there's a trade-off here for a little bit more growth. We're limiting that liquidity factor.
Right. And it's not that much more growth. So you need to really consider that when you think about it. But those are mainly the ones that I think of when I think of banks and think of what they have to offer. And again, it's all low interest because of our interest rate environment that we're in. And certainly something that, we shouldn't put too much money in, just our liquidity and what we feel safe with. I always tell everybody that if you're backing on the FDIC's reserve fund to back you up, they only have less than 2 cents for every dollar that's in the banking system. So it's really an implied guarantee that the government's going to be behind this, kind of like an insurance guarantee, the same thing. So no reason why we shouldn't put our money there, but there's also other reasons why we need to look for other investments.
Yeah, and when we say safe, that is an indication that the market is not going to take away money without us. We're not going to go back to that account and there's less in the account than we put there unless we've taken money out or we've spent money. It's not going to disappear without us having taken it. However, it's not completely without risk because the interest rate, the long-term growth, inflation, those are risks to even those bank accounts. And so, John, in order to get a little bit higher rate of return, we move out of the realm of safety and start shooting for growth. Even that side can have kind of a spectrum there of being aggressive or conservative, how much risk we want to take. And on the lower end, on the conservative end, we've been told that bonds or bond funds or fixed income funds generally are safer, but no guarantees there either.
No, I mean, when we're looking at a bond, even if it's a government bond, we're looking at if we need the money prior to maturity, and the interest rates go up, then I'm going to have to take a haircut on my bond. And so I'm not going to get my money back. So I'll get most of it, but I won't get all of it because I'll have to take a haircut on the payout. So bonds, government bonds are one thing. Corporate bonds, we're looking at the company and the full credit of their worthiness, the rating services, how they rate them. And here again, it trades in the market. So if I need my cash, I'm going to have to go out and find a market for that bond. And I may be able or may not to be able to sell it at par, which is what I got in it, or sell it for more so that I can get some of the interest.
Well, again, some risk there, although that's been utilized as the more conservative side of the portfolio, whereas the next option here, stocks, that has always been the more aggressive side. Again, a time and a place, pros and cons for all of these, but we need to be aware of what those are in order to properly locate our money, position our money, and have a balance of the goals that our money is working to help us achieve.
Well, certainly if we're going to need our money in a short term, then we don't need to have it in the stock market. The stock market's more for a long term. It is volatile. It's based upon the economy. It's based upon earnings of the companies. So really what you're doing is you're going in and buying ownership in a company by buying the stock, and you'll do as well as everybody else does based upon how well that stock does in the marketplace with the economy and also with its earnings. So there's a lot more risk there. But the one thing we don't want to do, Peter, is we don't want to buy today and then have buyer's remorse tomorrow because we're down a little bit. The stock market's more of a long-term play, as you know. It's not for speculators who are people who need the money. If you need the money, keep it safe, keep it somewhere where you can get it back. Fixed annuities have become a real source of a lot of money because they're fixed interest rates, which have been in the past higher than banks lately. And is a fixed term, short term, anywhere from 1 to 5 years. And it pays a decent interest rate. And it's deferred until you take the annuity out. So that's been a more safer play for a lot of people. But the stock market is certainly something that is for that excess money, the money that we have that we really don't need, that we want it to grow, and we're willing to leave it there and let the stock market take its toll on it.
So the fixed annuities, more like a CD alternative, paying a guaranteed rate for a set amount of time, then you walk away with the lump sum, some elements of safety and protection, plus a little higher growth rate there than probably what most CDs are paying. But the stock market, or the stocks, we are buying ownership in the company, and I expect, or I hope for two things. One, that the value of the company goes up. No guarantees there. And two, that the company is profitable. No guarantees there either. But that profit, that is kicked out in the form of dividends, where the value of the company is the actual stock price. A lot of people base their retirement income portfolio on the dividends, which can be a beneficial element of retirement income or reinvestment income, but again, not guaranteed. And there have been plenty of examples where the market has gone down and then companies aren't profitable at the same time. Those dividends get cut.
Ford was an example this last year. Ford had a decent dividend yield, 4 or 5 or 6%, but they cut their dividend out during 2020. So you actually got nothing other than the stock price, which actually went down. So that's an example of what will happen if you're living totally on dividends. But I mean, a lot of people do that. But if you're going to do that, pick a company that's got a trend, a history of paying dividends consistently, that has good ratings, and that is strong enough to make the earnings to pay that dividend no matter what. If you're going to live that way, it's certainly a way. A lot of people do that. A lot of people make good returns with that. But then long term, if you need to make a retirement account, the stock market growth funds are going to be the way to go. It's going to be the way that you're going to get your most return, but you're being paid for that risk you're taking. That's, you got to understand. The more I get return, the more chance I have for return, the bigger risk I'm taking. So it's just a question of where you want to fall on the pendulum.
Yeah, but to diversify some of that risk, if we buy one company, John, that single company may not compete. It may go out of favor. It may be mismanaged. I mean, Sears at one time was a fantastic company to own some stock in, but as they progressed, they maybe didn't keep up with, like an Amazon, even though the retail sector was still booming. Sears did not. Blockbuster, or we could even go into others that were maybe mismanaged, like Enron and Tyco or GM. All of those, the sectors were fine, but those individual companies did not fare well. And so to diversify some of that risk, we could look at things like mutual funds or exchange traded funds, ETFs, correct?
Correct. I mean, the way the mutual funds are buying a lot of different stocks and putting it into one fund that they've grown, like growth or value or whatever the nomenclature is. So what we do is we buy a lot of different companies, and when they pay their dividends, then that gets paid back to us. But we're not placing all of our eggs in one basket. I always think about Xerox and how back in the day, if you were going to copy anything, it was Xerox, and we still say that. You know, I'm going to go to the Xerox machine, even though I don't have one. But companies go and come, things change. Polaroid is an example. I mean, how many times have you heard Polaroid lately? But there for a while, it was the big thing because you got your picture instantly. So, you know, digital photography took care of that. So the ETF funds and the stocks funds, mutual funds, give us the ability to buy a lot of different stocks, put our risk, have limited risk, but also to be able to buy different sectors, different allocations based upon a lot of different things that we can look up and read. And that's what you're really talking about when you talk about diversification, is having your eggs, not having all your eggs in one basket, but spreading it around. And certainly mutual funds, ETFs are a great way to do that.
Well, John, it's all about understanding the benefits and the disadvantages that each one of these possesses. And there are some out there that basically malign one investment as never being a right or appropriate and saying another is always the right answer all the time. neither one of those is true. It's what are our goals? And then is this tool appropriate or inappropriate for those specific goals? And so it could be a bank is appropriate. It could be mutual funds. It could be stocks. You mentioned annuities. That's another one that is often maligned, but it certainly has some advantages for specific goals that an individual may have.
Well, sure. And you can do immediate annuities where you can put the money in and they'll start paying an income now. So that's certainly another way that we can get a pension or get a defined income. But Peter, the thing is that we look at all these different instruments, and what we need to do is we can't just put our money into a market or into bond funds and then say, okay, it's there, I'm never going to watch it. Because if we don't watch it, we don't know what's happening to it. I read an article yesterday that said that there are only a few, but every mutual fund that's made 100% in 1 year, and there were like 18 last year that made 100%, the next year they hardly make anything. So if you're going into a mutual fund and it's at 50 or 60%, you think, man, I got a real winner. The next year it may be at the bottom of the list because either the sector fell out or that particular mutual fund just ran its course and it didn't have any more steam. So we have to track and monitor this. And that's what the income plan does. With income planning, we're looking at all the instruments that make up your individual plan, your allocation, and we are tweaking that to make sure you have the best investments you got.
Very, very interesting factoid there. Tidbit to archive when you are looking at those past performance, not necessarily an indicator of future results, is the old saying goes. So again, got to understand our investment options, got to understand where our risks are within each one of them. And John, that's a process that you help people through. The Financial Focus Plan, it's a tangible document. It's simple, easy to understand language. It really outlines and defines where somebody is, what their goals are, and then the process of how to achieve those goals, utilizing some of the available options that are out there and helping somebody evaluate what options are best to help them achieve those important financial goals.
That's right, Peter. And what we're doing is we're looking at the tax consequences of everything, trying to minimize taxes, trying to make sure that we don't pay any more to the government than we have to.
Another pretty important aspect of all of these considerations, isn't it?
Well, as well as I do, that taxes have to go up. I mean, and that we're not spending less, so the government has to tax more to pay for this debt. So taxes are a big part of anybody's decision. And if you're paying taxes all the time on the stuff that you're making, you're really not making that much. You may not be making that much in the gains based on your tax bracket. So there may be some municipal bonds, things like that, bond funds that we can get you in to help save some taxes. There are a lot of different instruments. It just depends on your situation. No one person's the same. And it depends on what you're trying to get out of your plan, and then us putting that plan together and then monitoring it and watching it.
Well, if you need some help, you need assistance, if you would like to get that plan put together, if you'd like to get a better handle and understanding of your investment options, pick up the phone, give Gulf Coast Financial Services, John Kuykendall and his team a call, 386-755-9018, 386-755-9018. We put this podcast out as a resource for you to learn, but there's always the additional resource of some hands-on instruction, working with a team of qualified, experienced professionals to get your plan put together. Pick up the phone, give them a call if you would like to invest a little of your time, no cost, no obligation, get that plan put together, get a better handle on understanding your investment options. 386-755-9018. That's 386-755-9018, or online, gulfcoastfinancial.net, gulfcoastfinancial.net. That's your resource where you can find all the archive of podcasts, lots of reports, tools, calculators, things that you can use to further your financial progress. They make them available for you. GulfCoastFinancialServices.net, or reach out 386-755-9018. John, always a pleasure. We appreciate your time.
Thank you, Peter. Have a good week.
Be sure to like, subscribe, share, and tune in for more financial focus by visiting GulfCoastFinancial.net. The information presented on this program is provided for informational purposes only, without warranty of accuracy, completeness, or suitability for a particular purpose. This program is not intended to be and does not constitute financial, investment, legal, or tax advice. This information is general in nature and not specific enough to be construed as advice. You should not make any decision based on the information presented on this program without independent consultation with an appropriately licensed professional or competent advisor. Investment in securities or the market involves a potential risk for loss of principal. Trading, therefore, may not be suitable for all listeners. Annuity guarantees are based solely on the financial strength and claims-paying ability of the issuing company. Withdrawals of growth from annuities may be taxable as ordinary income in the year it is taken. Individuals should review contracts for specific details of the product's features and costs. Early withdrawals may subject the owner to penalties, fees, or taxes. John Kuykendall is registered with and securities are offered through Kovac Securities Inc., member FINRA SIPC, found online at www.kovacsecurities.com. Advisory services are offered through Gulf Coast Financial Services Inc., a registered investment advisor in Florida. Gulf Coast Financial Services Inc. is not affiliated with Kovac Securities Inc. or Kovac Advisors Inc. Past performance is not indicative of future results. All investing involves risk. Investment decisions should be based on your own goals, time horizon, and tolerance for risk. Due to various factors including changing market conditions and/or applicable laws, the content may no longer be reflective of current opinions or positions.